Hello everyone, this is Ahura and we'll be with you with the US labor market data and market reactions. As always, first let's check the data that we had and then we can see how we can expect or what we can expect from different markets and different assets. After a while, that's the first time we're gonna have NFP and initial jobless claims both at the same day on Thursday as it's because of US holidays. And so as always, let's check the data first, and then we can see what we can expect from these data based on the numbers that we had. Average earnings on the monthly scale increased by 0.2%, twice less than previous months. And usually, while this numbers is something around 0.3 and 0.4% that usually we are expect to see. On the annual scale, average earnings increased by 3.7%, much less than 3.9% and 3.9% expectations, and lower than 3.8%, which is lowered from 4% that we had previous month in revisions. I mean, revised lower. Previous month it was in initial numbers it was 4% on the annual scale. Average weekly working hours is lowered to 34.2 from 34.3, which means that the people working less, their income also is lower on the annual and the monthly scale. So less work, less income. What does it mean? It means that when you have a less work, less income, it means that the demand in the market is going to be lowered. So it's the negative number for the demand. What does it mean? It means that it's a positive number for controlling the inflation, which means that the Federal Reserve can say that, look, the inflation is under control, and now we don't have any pressure on the inflation from the labor data from the consumer side because the income is not such a high, especially if you look at the compared with the previous week's PC and core PC numbers as well. They were telling also the same data. I mean, they were showing also the same data. So people have less demand based on their less income. So when the demand is lower, which means that inflation is under control. So inflation is under control. At the same time, the labor market data. Okay, let's check the labor data. Labor data says that initial jobless claims slower to 233K. 233,000, much less than 240,000 expectations, while the previous month also slower to 237. So it means that the people they have a less demand to receive the unemployment benefits. On the continuing jobless claims, it also was unchanged at 1,964,000, same number of the previous month. So slightly 4,000 more than expectations, but generally fine. I mean, less than 2 million, which is fine. Exports increased. Sorry, let's talk about the export and import in a different video. Now let's focus on the labor market data. 4 weeks average jobless claims at the 4 weeks average slower to 241,000 from 245,000, which means gained another confirmation of the positive labor data. NFP or non-farm payrolls, the main data. We had 147,000 newly created jobs, much better than 111,000 expectations, and slightly more than 144,000 that we had in the previous month, in May. So, labor market created much better jobs, better than expectations. That's why the unemployment rate slower to 4.1% from 4.2% that we had previous month. And it's much lower than 4.3% expectations. So unemployment rate is lower to 4.1%. Labor markets saw 147,000 newly created jobs. This is on more data and more detail, we can see that on the private sector, while we're expecting, I mean, the previous month, the number of the jobs that was created, it was 137,000, and we were expecting 105,000 another created new jobs, but market created 74,000, slightly lower than almost 25% less than expectations. But at the same time, if you look at the government's created jobs or the government's payrolls, we can see that from 7,000 that we had in May, it's increased much faster to 73,000. So we have 73,000 newly created job in a government sector, which means that's why the overall NFP increased to 147,000. So the government sector hired much employees than expected. So we have more newly created job. At the same time, unemployment rate fell to 4.1%. So the labor market is fine, positive. Income slightly lowered, which means that inflation can be under control. Labor market is fine. Putting these data together means that market can say now that the U.S. Federal Reserve shouldn't be in pressure or in hurry to change the interest rates, because labor market is fine, interest rate also is, inflation is under control and labor market is fine. So there is no rush to change the policies before having more reasons to make it or to go to that side. So more accommodative policies or current rate could be there for longer. That's what means these data. That's why we can see that the US 10 years bond yields increased so fast, rapidly, right after the data. Checking the FedWatch tools, we can see now we have more than 95% chance for holding the current rate in this meeting, in a meeting that we're going to have at the end of this month, and for the Federal Reserve. While in September also, now we have 73% saying almost didn't change the chance of the rate cut. So these data can say normally that nothing can change here, nothing specially changed here. Generally, the data says that the US Federal Reserve shouldn't be in hurry. Now, yeah, there is other reasons could change the idea of cutting the rate in September, and there's a chance of more than 73%. But generally, the data so far we had says that Federal Reserve from the economic side and economic data front shouldn't be in a hurry to change the rates, to cut the rates. Yeah, as I mentioned, geopolitical tensions, trade war, and other stuffs can change the idea, but data on the economic front says that the current rate could be held for longer. Holding the current rate for longer or higher for longer policy. Usually these numbers, which I mean the higher for longer, means that the holding the current interest rate for longer, which is the positive for US dollar. Well, because when you have a higher rates and higher yields, your demand for your yields can increase. So people should buy the dollar index, dollar yield. So the demand for the dollar can increase. When the demand for the dollar increases, it's positive for the US dollar. That's why we can say these numbers can hold the downtrend that we had in the dollar index, and so that's a positive, generally the positive news for that. So uptrend can continue here, upside. So dollar index can continue its overall uptrend from here, and we can say that, I mean, not the overall uptrend, we can say that can end its overall downtrend here and can continue its slight movement between 97 and 100, 96, 50, and 100, this area. So generally, these data are positive for the dollar index and can lower or can limit its downtrend that we had in the market. At the same time, when we have slightly higher yields expectations, that number is negative for US dollar. That is negative for the gold, because higher rates usually they have an opposite direction with the gold price. So it can put the pressure, while the dollar index also should be positive. So yields and higher yields and higher rates for the dollar index could be reasons to see that a little bit pressure on the stock market, on the gold price. At the same time, these data confirms that the labor market is fine, inflation is under control, based on the positive news that we had from stock markets, Tesla reports, and other data that we had so far today. We can say these numbers can hold the overall positive environment in the stock markets, and you can hold the overall uptrend that we have right now there. So for S&P 500 especially, 6,100 is a key level, and as long as we have these level hold, this level held at the prices around above this level, we can see that the overall stock market can be positive and the S&P 500 can continue its uptrend. So these numbers couldn't be negative for the stock markets, and based on the other positive news that we had in the market, while the holding the current rate in the June meeting, it was already priced in the market, so we cannot see the pressure on the stock market. So these numbers could be still holding cannot change the market reactions, cannot change the market tendency, cannot change the market interest, but at the same time we can see the more chance for higher for longer, that chance can limit the uptrend, but it cannot change the trend. But the uptrend could be limited. It couldn't be changed for now, but it can be limited. So while we have a positive reaction in the stock market, so that's generally fine for the energy market and oil as well. And anyway, the oil, there's too many other options playing the rules in the oil and energy market, but still these numbers couldn't be negative for the oil market. So oil, the slight recovery that we have in the oil price can continue around $67-70 for WTI. So while the positive data for the stock markets, generally there's the slightly stronger US dollar, all of these data are reasons to see gold price under pressure. So we can say for now, with these data, based on the data we had, we can say that the gold can continue its previous downtrend slightly lower, and we can say that for now, before new trend starts, gold trend can be changed slightly to downtrend, but it can be slightly, not sharp downtrend. As for the cryptocurrencies, these data can lower the market risk, and when you have a less risk in a market, generally it means that the risky assets can have more demand. However, as mentioned before also, these data cannot react directly on the cryptocurrency market, because crypto market is already independent and they have other factors to be checked. But still, these numbers can support the demand in risky assets, especially including Bitcoin and other cryptocurrencies. So that's what we had as what we expect as a reaction. So positive slightly for the cryptocurrencies, for the stock market positive, with the limited uptrend. For oil around 67 and 100 is our expectations. Negative for the gold based on the positive reaction in the stock markets and the increasing dollar index, while the yields also increase. That's what happened during the market, and as the reactions what we can see in the market. Hope it was helpful for you, and if you had any other question, don't forget to write in the comment section or try to get back to you as soon as I can. Have a good time. Bye bye.